Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by managing director and technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey Ross, I'm super. It's always great to speak with you.
Great to talk to you as well. A lot to get to. We're going to talk about big tech and market concentration, but I actually want to start on the flip side of that, which is outside of tech. What is working right now, and what does that tell you about the state of things in either the market or the economy?
Yeah, I mean, it feels like nothing is working besides just tech and semiconductors. But I think if you look in some other corners, right, and it's a little bit more selective recently, but even in areas such as biotech, large cap biotech, there's some strength there. Even in, say, infrastructure and the industrials, there has been some strength. Yes, those names are pausing, but they have been leaders for quite some time now. Now, they don't have the influence that technology stocks have, but I think if you look around, anything away from, say, consumer staples has been able to catch somewhat of a bid, even in utilities, right? And I know that might be an AI or a nuclear type play, but there at least are opportunities, and even abroad too, right? Europe, outside of the last week or so, has had a pretty good run. Japan's had a fantastic run. China has started to perk up. So it's not all just technology. There are places to hide. They just do not have the influence that they have on the S&P 500. And I think that's what's causing a lot of consternation in terms of where to search for, where to find the alpha in the indices.
Yeah, and let's just get to that influence that big tech has. Obviously, some records being set for market concentration in terms of top five, top 10. What I mean, just at the highest level, what is your takeaway from the market concentration? Does it portend anything? Does it mean anything to you, or is it just a kind of a fact of life here?
It's a fact of life, totally. I'm in agreement with you there, Ross. Now, this is how indices work, right? When you have these trillion-dollar companies, you think about it in a sports analogy, right? The biggest players are supposed to influence the team, the index, the most, right? They score the most points. It is not bullish or bearish, right? You can get some really interesting market stats and the evolution of indices today versus 10 versus 30 years ago. That's just how the environment is now. But it does not portend that there's going to be an issue. If you wanted to do some due diligence, this is when it makes sense to pay attention to what the equal weighted indices are doing. What's the equal weighted S&P 500 doing, right? And that's still okay shape. Yes, it has consolidated over the last month or so. We're okay with that, particularly because trends are still decent. But this is when you want to look under the hood, right? Indices can mask weakness. They can lie to you in terms of what's happening, similar to how a car works. The car is still driving, but maybe internally there might be issues in the near term. So yes, it is a fact of life. But again, go back and look at what all the equal weight indices are doing. They're still largely okay. Yes, they could have a summer speed bump, a little bit of a corrective environment. But largely speaking, as uncommon as this might be, we don't necessarily pretend it as bullish or bearish going forward.
And so, with the big tech concentration, with the new technology driving this enthusiasm, it does echo dot-com bubble for a lot of investors. And so the question becomes, what is sentiment like? Is it just okay? Is it excited? Is it euphoric as we saw in the late 90s? I think along this way, this AI journey, taking temperature of sentiment is going to be really important. You do a lot of work on that front. What are you seeing in the tech sector specifically, but then for the market writ large as well?
Yeah, it's a great question. And I would also point out, related to those big tech names, compared to the tech bubble, Ryan Grabinsky has done some great work on this and how their market cap weighting is in a way justified due to their income weight within the S&P 500. That's a big difference versus the tech bubble 24 years ago. Now, in terms of sentiment, our flows work, which we find to be a great clue on investor sentiment, is only hot within technology. And that's been the right call. It has been all in on ETF flows for the technology sector. Whether that eventually leads to some sort of downturn, we'll see. But every other sector has seen outflows over the last, call it 6 to 12 months, which I think is really interesting. And the broader market flows ran hot earlier in the year. They have cooled off. And so it might be a little bit euphoric for technology. That's okay. But we are nowhere near euphoria compared to, say, even back in 2021 during the original meme craze in terms of sentiment there. Yes, some surveys are hot. You could say there's a pinch of complacency from the put call data in terms of call option volume, but I think it's a vastly different environment today versus 3 years ago, and perhaps even back into the tech bubble. I know the data runs a little bit different there. And so I'm curious to see if you start to see flows more into the broader market, into other sectors as the summer goes on. But so far, it's really only tech where you're seeing kind of this excess optimism. And of course, that's been rewarded. Eventually, though, that may turn into a headwind as the sector continues on here in the coming months.
Well, it's as you've noted as well. People love cash. People love 5% yield. So it's going to take something pretty heroic to pull that money in off the sidelines into those other sectors. So we'll keep an eye on it. Todd, thank you so much for the time as always, and we'll hope to talk to you again soon.
Great. Thanks, Ross. Appreciate it.